We begin, of course, with the markets. The Dow's best day since June. Stocks continue to stage that strong rebound. Jim, I guess this is the market saying the virus is a big story, but maybe the worst has passed, or it's not going to be as bad as some originally feared.
Yeah, I think that's a logical conclusion. I think it's also fair to say that there will be some repercussions, and the repercussions will be transient. They won't be that great. But look, we've got Disney. I think after the close today, I should know since I just bought shares. We talked about that last week. I bought shares last week. But you know, what do they say about Disney Shanghai, and not just Disney Shanghai, but what do they say about theme parks overall? You know, I flew this weekend. I'll say, you know, just one person's anecdotal report. I thought the airports and airplanes were really empty. So do airlines come out and say something? Look, all of this should be localized to the first quarter, but we have to expect that there will be some reports of negative impact from the coronavirus, and that should give buying opportunities.
So, Joe, I'm going to use a word that you've talked about often recently, and that's liquidity. Okay? To me, this market comes down to liquidity versus the virus, and liquidity is winning right now.
100%. To me, that it's remarkable, the price performance for the S&P over the last 2 days. Yes, factory orders were good, manufacturing were good, but okay, Alphabet last night had a slight miss, disappointed the market. It's about liquidity in a geographic region that needed it really bad.
Right. China's stimulating. Global central banks are engaged.
That's
U.S. central bank is very much in play. There's still the belief you got to put your money somewhere in this environment, and why not here? And yes, I'm not trying to minimize it in any way, shape, or form what's happening globally with the coronavirus. But to me, it seems like that's how the market has voted.
Yeah, and I also think the fact that it really has not built momentum in headlines here in the U.S., and we have not seen, thankfully, the spread domestically here in the U.S. It seems to be somewhat isolated to Asia. I think that's helpful. But again, it just goes back to it started the very first day of 2020. When the PBOC cut the reserve rate requirement 50 basis points. And now they're committing $50-something billion more to the market. That's the one economy and market that needed it most. And it just adds to the liquidity ocean.
Yeah. Okay, Steph. So Tony Dwyer, our friend, he's frequently on the show, says you've got 4 fundamental reasons for optimism to remain in place. 1 is what we're talking about. Fed's going to continue printing money. Money's widely available. Number 2, economy here is doing well, and you have an inflection in the global economy. Things are better in Europe and maybe elsewhere, too.
Yeah, we talked about that yesterday, right, with the PMIs being a little bit better in the Eurozone and in Germany and the UK, and then here, of course, as well as new orders here in the ISM report. The CDC yesterday, I thought, gave us more confidence in terms of having a better handle on things. No, it's not solved, but at least we feel a little bit better. But I have to tell you, I think this is all about earnings today. I truly do. We've had some really good numbers come out today. Let me list a few. Emerson came in line, but they actually had better free cash flow. They actually raised guidance. This is an industrial that has a ton of exposure to China. And as a result, all the industrials are rallying. NXPI, we were all worried about auto. Auto actually beat expectations. Industrial also beat expectations.
You remember how earnings growth at the, a week ago was negative?
Let me finish my list.
And now it's, to your point, though, I'm going to help you get along.
Okay.
It's earnings growth was negative as we started and sort of, got going.
Yeah.
Now we're back positive. I'm not saying it's gangbusters, but 1.5% to the plus side rather than negative. I'll take it.
Yeah. And it's not just that. It's margins as well. I mean, even I look at Clorox. I mean, that's the reason that stock is surging today. Well, organic was a little bit better, flat instead of down 2, but margins actually were better than expected. Ralph Lauren guiding to the high end of expectations. North America same-store sales at 4%. I could list 5 other companies other than Google that had really good numbers. And I think that's very, very encouraging. And I think at the end of the day, we're probably going to see 3-4% for this quarter. And I wasn't expecting anything near that. You know that. And I'm an earnings bull, right? I thought that this was going to be the trough. If this is the trough, then we have a lot to look forward to in 2020.
Well, to your thing you talked about a lot, at least from a global manufacturing standpoint. That number yesterday got a lot of people thinking that, okay, maybe the worst is certainly behind you. You do a 50 after you're thinking you're going to be stuck in the 40s for a bit. That changes the narrative, too.
Yep.
We were stuck in the 40s for a bit. I mean, 50 was very well expected. The U.S. ISM has lagged all the other developed countries' PMI. So if that hadn't come in above 50, and I know expectations were lower, that would have worried me. Now, Steph, you and I were talking about this before the show started. Emerson, Cat today, is that
United Rentals?
Is that risk on, or is that a response to Emerson? And I'm going to disagree with you, okay? Because Emerson, I just look at the sales, $19 billion. I don't know that that's really really the bellwether that I look at. But I will say, look, it's a mixed bag, all right, because you got auto sales yesterday that were much better than expected. On the other hand, you've got Google that just, missing on revenues is not really what you like to see. And what I'm putting this all together, and I'm saying this is a great opportunity to have some dry powder. I still stay with that. I put some to work last week. But having dry powder, I think today is just a risk-on day. I'm not sure we're off to the races.
What was yesterday?
I'm sorry?
What was yesterday?
More of the same. I mean, you can have 2 days of risk on in a row.
Okay, but at what point do you say, okay, this is actually something to buy into? It sounds like you're apprehensive to do that.
I'm not apprehensive from a fear point of view. I'm really just being patient. I mean, this is what Jimmy Cramer's been saying for the last week and a half.
I mean, pick the word.
Okay, so you know what? I'd like to see a third day follow through tomorrow. I find it hard to buy today after basically all we've done is reverse Friday's decline. I'd like to see us move towards a little closer towards a new high on the S&P 500. Give me tomorrow. And I'm on with you tomorrow, so we can talk about it.
I'm surprised to hear you talk so generally about buying. Usually, I know you to be able to find opportunities. And technology,
they're there.
I mean, you could find those opportunities on a down day and up day. It's been spectacular what has gone on here with technology, the recovering. I talked about semis yesterday. I think you could look at a lot of the semis right now, which are beginning to rebound back. There's a tremendous recovery period that they will experience if the overall market gains momentum. Take a stock like Netflix, very quietly. Netflix is right back up to 365 once again. There's a long runway there in terms of recovery. So I think you could mine for opportunities with a lot of equities.
You're absolutely right. And you mentioned the chips, and Qualcomm is very much on my mind. We talked about it last week. It's at 88 today. 83 was that line in the sand. Steve Weiss is a raging bull on this. He and I have been talking about it a lot. I used to own it. Look, all I'm being is very price conscious. Maybe I'm being too price conscious, but I'm fine doing that. I just don't feel today or yesterday impels me, moves me like I have to get the cash into work right now.
You do agree that you have to follow the companies that have reported good earnings. And it has been semiconductors that actually have delivered. And it was Intel. It was even AMD. It was a bad reaction to AMD, but it was AMD. It was Lam Research. It's NXPI.
Texas Instruments.
Texas Instruments. So they should recover. Those are the ones you want to buy on weekly.